I bought a rental property. I bought a rental property. And I came back home and I said to Kim, time to sell.
You know, for me, and maybe you as well, the landmark book, Rich Dad, Poor Dad, really opened up the door to a wealth mindset. You know, it kind of asks those great existential questions like, why would you live a day below your means when instead you could expand your means?
People say live below your means.
But you know, maybe the next logical question for you is, now, how did the author, Robert Kiyosaki, become financially free himself? Now, Robert Kiyosaki's business before the Cashflow board game and all of his educational platforms was residential real estate. And interestingly, he and we both started out kind of, I would call it, in the periphery of the United States. Him with a property in Hawaii, me with a property in Alaska. And Robert Kiyosaki's been a great contributor. He's been here on the show with me for different times. Robert, take us back to the 1970s as far as from a monetary perspective and what was going on at this time and how that ushered in a new era of inflation.
On August 15, 1971, Tricky Dick Nixon announced on the program Bonanza that he was taking the dollar off the gold standard. So Dick comes on and says, hey, adios, our promise. So they broke the contract with the world. And the dollar became what's called fiat currency.
And he's clearly seen as a thought leader in our space. And recently on an episode of his show, he made some remarks about investing in real estate. So let me unpack that for you. We'll take a look at what he said in a moment. And, you know, I think he helps you ask yourself a better question and he gives you some mindsets for real estate investing. I like to think that I do that as well. But I really go on that next deeper level, talking to you about how to make it actionable. And sometimes I even do that as a geographer, going into that next deeper level, diving in city by city because the market is more important than the property. And coming up here on the channel, we're going to do a series about looking into real estate geography city by city and what you need to look for as an investor for a durable source of cash flow. Robert does a great job at keeping things high level and then encouraging you to go further. If you're watching me, you found that next deeper level. But let's play this from the Rich Dad radio show. This clip is less than a minute long.
I think it was Rockefeller, one of those guys said is, when shoe shine boys are giving you stock tips, time to get out. And I was in Safeway the other night, and these people are coming up to me, I did what you said, I did what you said. I bought a rental property, I bought a rental property. And I came back home and I said to Kim, time to sell. You know, it is so dangerous, but you can't talk somebody out of it because they drank the Kool-Aid. Years ago, Taiwan Semiconductor moved to Arizona. When Kim and I moved from the Communist Republic of Oregon to Arizona, one reason was because Taiwan Semiconductors moved through the desert of Arizona. It's a place called Silicon Desert. So you've got to move where the industries are moving to. Manufacturing had to come back to the States, and that's what's happening right now. Intel just announced a huge development in Ohio. There's going to be a boom for Ohio. So that's how you make money. You got to pay attention. Don't listen to your stupid real estate agent who tells you that, oh, the price of real estate always goes up, because it doesn't.
Yeah, I think what Robert's saying is you really need to zoom in and look at some of those macro market and larger trends. So I've really got three big takeaways in this regard here with real estate investing. Number one is coming from that perspective of the market being more important than the property. You generally want to invest in real estate in a place that has a population that's either stable or growing. You know, a lot of people, maybe you would want to buy a fourplex building and you like it because right now it is 100% occupied by tenants on the day that you buy the building. That's how a fourplex often is inherited when you purchase it, unless it's new construction. And maybe you're thinking, that's great, but you know, that's not all, because when you buy, just say, a fourplex building with 4 families in it, you don't buy it so much for the fact that 4 families occupy it today with 100% occupancy. What you should be doing with respect to the fact that the market is more important than the property is purchase that property with the reasonable expectation that 18 months from now, when one of those 4 families leaves, that you're going to be able to get another tenant or family in there that would probably have the capacity to pay the rent because you have a stable or growing population with a base of jobs. That's exactly what I mean with the market being more important than the property. What's the durability of the income stream? And there are some interesting trends with respect to that. Robert touched on some of those.
Intel just announced a huge development in Ohio.
We think about something like manufacturing with what happened in the world with that COVID shock a couple years ago, and the trend of nearshoring, maybe bringing some manufacturing that had taken place in Asia to Mexico, or even reshoring, bringing some of that manufacturing back to the United States, and how that opens up more opportunities for viable markets for you to invest in with real estate. The market is more important than the property. Now, government and politics matter as well, because you typically want to be in an investor advantage state. Oftentimes those places are in the United States Midwest and South. Just to give you some concrete examples, as we look at a map of the United States here, we're talking specifically about states like Ohio and Indiana and Missouri and Arkansas and Texas and Oklahoma and Tennessee, Alabama, Mississippi, Georgia, Florida, up through some of the mid-Atlantic states and some of the Intermountain West states as well. So what do I really mean by investor advantage? That's generally where the laws, the landlord and tenant law, are more favorable toward landlords. Nothing more important really than that one being, for a non-paying tenant, can you get an eviction in about a month? In some places on the United States coasts, it can take you 9 months to get an eviction. Robert touched on what he called the communist state of Oregon. California and Oregon are two states where there is some measure of statewide rent control, where there's a ceiling on the amount of rent that you can charge. Well, that's not good for you. And I mean, over the long term, that's typically not good for tenants either, because how motivated are you to improve a property when you can't get more in rent? So that's a second of three things that comes up here. You want to be invested in what I would call an investor advantage states, often in the United States Midwest and South. And the third takeaway, and come on, this is so fundamental, is that you want a cash flowing property where the rent exceeds the expenses. And here's the reason why this is important. It almost makes real estate pricing inconsequential. And I'll tell you more about that in just a moment. Hey, go ahead and put a like on this if you've learned something. It gives me some feedback that you like the type of material that I'm dispensing here. When I say rent should exceed expenses, I've got a quick and dirty way for measuring that. Rent income minus mortgage and VIMTUM should equal a positive number. VIMTUM is vacancy, insurance, maintenance, taxes, utilities, and management. When I talk about the fact that pricing is almost inconsequential, if you're a long-term real estate investor, it's going to be okay, because look, I bought property for cash flow that went down in value shortly after I bought it. And what happened shortly after I bought that building? We went into the global financial crisis. My $530,000 fourplex fell in value to $480,000. That didn't feel good. It lost like 10% of its value, and I had never experienced anything like that before. But what did I soon realize? You know what? Unless I'm trying to sell this building or refinance this building, the fact that it's temporarily suppressed in value, it's temporarily worth less than what I bought it for, it really doesn't matter that much, because my rent income exceeds all of my monthly expenses. My rent income was something like $6,000, and all my monthly expenses on that building were something like $5,000. So I had, say, a plus $1,000 positive cash flow. And you know, the other thing that happened is people really lost faith in the housing market, like in 2008 and 2009. So I was actually able to increase my rent incomes. I had more demand for rent. In fact, it was so bad, people couldn't even get loans a lot of times back then. So it really increased my rental demand. So my point is that the capital price that was temporarily suppressed in value, it was relatively inconsequential. I mean, how bad would it be if you own something that's temporarily suppressed in value, but it's paying you better every month than it ever has before? So yeah, Robert's right. He says, in a sense, don't listen to your local real estate agent. They say that real estate always goes up. Of course, it doesn't always go up, but I just gave you a very concrete example of why it doesn't always have to go up, because you're paid so many ways at the same time. You know, I am geographically agnostic. I invest across state lines in the best metros in the best states, and sometimes those things change over time if the prices run up faster than the rents do. Those are three big takeaways when it comes to being a long-term real estate investor. Buy in a place where the population is stable or growing, buy in an investor advantage state, and buy where the rent income meets or exceeds all of the property expenses. Hey, I'd really appreciate the like if you learned a little something or liked this perspective. My name's Keith Weinhold. Thanks for being here, but you weren't here for me. You were here for you. I'll see you in the next video.